Okay, so let's start again. All right. And we're covering uh, Chapter 19, share-based compensation and earnings per share. All right. And so, as I started saying, this is broken into two parts. Share-based compensation. The big problem with that is the matching concept. And then the second part is earnings per share, which really has almost nothing to do with the beginning of this chapter. And so pretty much from here on out, we're just kind of tying up loose ends, all right, until the end of the semester. All right. So as I said before, this content, it's not easy. I'm not saying it's easy, but it's definitely easier, okay, than some of the stuff that we've done in the past. And so, okay, the first part of this chapter deals with the share-based compensation, all right, and you know, up to this point, the whole calculations of salaries and salaries payable, so if they had earned some stuff, but we hadn't recorded it, we had to make an adjusting entry at the end of the year. We did our pensions last chapter. We did vacation pay, because that's just, we're setting that as an accrual, all right? And so really what this is when we give our employees, the opportunity to either purchase our stock or to flat out, we give them those shares, all right? And so shared-based awards are forms of payment whose stock is tied to the market price of the company's stock. So if you can think of a really good motivator, okay, to get employees to work hard, right? One of the things would be, doing things that would help the company as a whole, all right? And so my cousin actually sells $1 million yachts, and he had broken away from one of the companies that he was an employee and basically started his own yacht selling business. And after several years, one of his competitors came and bought him out, right? And so when they bought him out, they gave him some cash up front, right? But then they gave him stock options in the parent corporation or the company that had bought him out. But the deal is that he would not vest, all right? So if you remember that term from last chapter, all right, where he actually would not get those shares of stock unless he worked for the company for 10 years. So if he left, all right, because when they bought him, they didn't just want his location and his inventory. No, they wanted my cousin because he's a top salesman. All right. And so, to kind of lock him in, they said, hey, we're going to give you all these options of shares. And in his case, they were just given to him. He didn't actually have to, like with a stock option, you have to buy that. You get to buy it at a lower price, but you still have to pay for that. Where my cousin, it was just a flat out, hey, here's the shares, and happy on your way. All right. Well, the problem with that, okay, was that about 6 years into it, the economy, this was back in 2008 or whatever, it went into the crapper. All right. And the parent company actually ended up filing bankruptcy, and so really my, even though my cousin had stayed there, all right, he didn't vest, all right, so he really wasn't able to take advantage of that, all right, so kind of lost, all right, he lost his business, he lost, the big payout, which would have been those shares of stock. Does that make sense? Okay, and so if you think about a good compensation method, all right, if you tie it to the stock price, okay, obviously that employee is going to work hard because they will only be helping themselves because they're now, or they will be an owner, right? And so, it's a really good method of, motivating employees, right, to work hard, right, to benefit the firm as a whole, therefore benefiting them as employees. Okay, and so they're basically talking, share-based compensation plans include stock award plans, stock options, and stock appreciation rights, okay, or one of the several similar plans. The goals are to provide compensation designated to designated employees, while sometimes providing those employees with a performance incentive. Okay. And so my whole little scenario we talked about. The accounting objective, right, is to determine the fair value of that compensation and to expense that compensation over the periods in which participants perform the services, right? So again, you know, the employee works, he gets a benefit from that work, right? And so, you know, the corporation is going to expense that benefit against the revenues that that employee is earning or generating for the company. So there's several different types. There's the restrictive stock plans. These plans are tied to continued employment. Okay, so you have to vest. All right. The two primary types of restrictive plans are restrictive stock awards and restricted stock units. Okay. Restricted stock awards. All right. The shares. All right. Are in the name of the employee. However, the physical possession retained with the company. All right. And so, you know, the idea of this is that, you know, that employee can't go and sell those, all right, because they don't have the physical possession. But it's basically saying, hey, this is yours, all right. You can't touch this, all right, but you know, you're going to benefit from this, right? You know, they're subject to forfeiture by the employee if the employment is terminated, all right. So whether they're fired or whether they leave the company, all right, within a specific number of years, all right, from the date of the grant. And so, example, my cousin had to work 10 years, right? You know, so, you know, if this was, I don't really know what his was, all right, but if it was a restricted stock award, okay, yeah, they had his name on it, okay, but the corporation was keeping those, all right, or physically retaining them. They're not free to sell the shares during the restricted period, okay, but after that restricted period, they're able to receive those. The compensation associated with the shares of restricted stock is the market price at the grant date of an unrestricted share of that same stock. All right, and so, you know, basically the market price, right, of the shares that are publicly traded at the grant date. Restricted stock plans, all right. You know, so the other method is this restricted stock units. Okay? It's the right to receive a specific number of shares of the company's stock. All right. The company distributes the shares after the recipient of the RSUs satisfies the vesting requirements. The recipient benefits by the value of the shares at the end of the vesting period. All right. And so, you know, he doesn't, you know, so in the first example, they recorded that expense, right, based on the you know, at the issue, or what was it, the what do they call it, the grant date, right, when they were given to them, right. You know, that was when they calculated the expense. This one, however, all right, it's at the end, right, of the vesting period. So the terms of restricted stock units can vary. The recipient sometimes is given the cash equivalent of the number of shares used to value, all right, those RSUs, or they might just be given, yeah, they can either give them stock or they can give them cash. And so just a note, all right, from Apple, okay, an example of the note disclosure, okay, share-based compensation cost for the RSUs is measured based on the closing market value of the company's common stock on the date of grant. The company recognizes share-based compensation costs over the award's acquisition service period on a straight line basis, which, as you will see, they're generally all expensed on a straight line basis. So here's an illustration of the RSUs. Universal Communication grants RSUs representing 5 million of its $1 par common stock to certain key executives as of January 1st, 2016. The shares are subject to forfeiture if the employment is terminated within the 4 years. The shares have a current market price of $12 million or $12 per share. $12 million per share. All right. And so on January 1st, okay, when they're actually given these, all right, there is no journal entry, okay, but we calculate the value of this, all right? And so we took the $12 per share times the 5 million shares, and we come up with 60 million. Right? So again, right, to get all this money, right, or the value of this, those employees had to work for 4 years. So what we're going to do is we're going to spread that or amortize that over 4 years. So we're just going to divide the 60, right, by 4 years, and that's going to be $15 million per year. So on December 31st, all right, we're going to go ahead and record, all right, the compensation expense, right, the 15 million, and then paid in capital restricted stock, right? Because we're not giving them cash at this point, right? We're going to increase our obligation, or in essence, our paid in capital. And so expense decreases net income. Net income carries to the retained earnings, right? So the retained earnings would be lower by 15 million. However, we offset that with paid in capital of 15 million increase, and so everything stays balanced. Then finally, all right, at the end, all right, of those 4 periods, okay, in this case, we didn't give them cash, we actually gave them the stock, all right? We record the common stock, number of shares times par, so it's 5 million, $1 par. We record the paid in capital excess of par, right, the 55, and we reduce the paid in capital from restricted stock. And so again, this is just a wash, right? Paid in capital goes up by 60 and goes down by 60. However, in those 4 years, we matched the expense against the current revenues that those employees were earning us. We account for restricted stock awards the same way, all right, as we do for RSUs. Okay. Stock option plans. A stock option plan gives the employee the option to purchase, right, a specific number of shares. So in the previous 2, all right, methods, okay, we just gave them the shares. Okay. With these, they actually have to pay a certain amount of cash to the organization at the option price, right? So it allows a specific number of shares of the firm's stock at a specific exercise price during a specific period of time. Historically, options were measured at their intrinsic value, all right? And so an intrinsic value is really what is it worth, okay? And so that is going to be different than the current market price, okay? See, in the past, and this is relatively new, actually, since I've been teaching, they actually changed the rules on this, right? Because in the past, they would not require salaries expense or compensation expense. Because generally what would happen, all right, so let's say that I'm the organization, you're my employees, all right? Our stock is currently trading on the market for $10 a share, and I give you the option to buy our stock, okay, at a specific price, all right, for a specific amount of time. All right, so in 4 years, I allow you to buy our stock for $12. Okay. So did I really give you anything? The current market price is $10, all right? And so this option is to buy our stock at $12. Nobody's going to exercise that, okay, unless the market price changes. And so that's the whole idea of enticing or encouraging the employees to work harder. Because if they work harder and the stock price goes up, okay, then these things will actually be worth something. So if we can get this thing up to $15 a share, because of over the next 4 years, then we will benefit, all right, that $3 per share. Does that make sense? Because we're still going to have to buy it. It's just we get to buy it at $12, and then we can turn right around and sell it for $15, making $3 per share. Does that make sense? Okay. But here's the deal. In the olden days, all right, there was no compensation because, you know, they're working right now. There is no guarantee, okay, that that stock price is going to rise above, okay, the option price. Okay. And so we didn't have to worry about it. There was no compensation recorded. But because of the matching principle and a better application, and it is, all right, because see, those employees are working hard for those 4 years in order to get that stock price above the option price, right? And so they're working, or they might be working harder, okay, so that they have some sort of benefit. And so this intrinsic value, okay, is something that we're going to tap our actuaries on the shoulder for again, right? Because it's not something that you are going to have to calculate. An intrinsic value, all right, is a historical, or not historical, a futuristic guess. So intrinsic value equals the market price of the shares, subtract the option price at which they can be acquired sometime in the future. An option that permits an employee to buy $25 stock for $10 has an intrinsic value of $15. So recognizing the fair value of those options. Compensation now is measured at the fair value of the stock options at the grant date. Right? And so again, this fair, okay, you know, this, see if I can, actually I like the highlighter. See if I can highlight this, all right? You know, so that intrinsic value, all right, is really going to be this fair value of the stock options. Okay? And again, this is going to be at the grant date. Okay? We record that amount of compensation expense over the service period for which the employees received those options. All right. So again, if they had to work 4 years to earn those options, okay, we're going to spread that over the 4 years. The fair value is an estimate. It's an estimate by employing a recognizing option pricing model. Okay? And generally, that is something that an actuary will be able to provide for you. So they have to be a recognized option pricing model. It can't just be, yeah, I feel like blah, 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 blah. You know, no, you have to have some evidence or some due diligence in that calculation. Okay. An option pricing model takes into account several variables, right? The exercise price of the option, expected return term of the option, current market price of the stock, expected dividends, expected risk-free rate of return during the term of the option, expected volatility of the stock, all right? And so, you know, a lot of variables there. Okay. Thankfully, all right, on the exam, and I believe in your homework, all right, you're not going to have to calculate that. You're just going to have to, it will be given to you. And so here's an example. On January 1st, 2016, Universal Communications grants options that permit key executives to acquire, okay, not just giving them to them, 10 million of the company's $1 par common shares with the next 8 years, within the next 8 years, but not before December 31st, 2019, the vesting date. All right. And so really what we're looking at all of 2016, 17, 18, and 19. Again, the 4 periods or the 4 years. The exercise price is the market price of the shares at the date of grant, which are $35 per share. All right. The fair value of those options is estimated to be by a appropriate option pricing model to be worth $8 per share. And so on January 1st, all right, we're not going to have to record anything, but because that was the grant date, all right, we do our calculations. We take the estimated fair value of the option, $8, times the number of options granted, 10 million. And so we have total compensation of $80 million. Allocation to compensation expense, all right, we're just going to take that 80 million, spread it over the 4 years, okay, that are required for the employees to remain employee. They don't call it that apparently, but it's in essence the vesting period, right? that you can't exercise it until you've worked for 4 years. And then we record, all right, so we made the journal entry, okay, compensation expense, paid in capital, all right, for the first year and for the subsequent 3 years. So again, all right, we are not giving them cash. Okay? We're giving them, these stock options, which is part of the paid in capital or part of your equity. As of January 1st, 2016, yeah, so they're adding on that red portion. I should know that. A forfeiture rate of 5% is expected, right? Which basically means that, hey, over the passage of time, all right, they're expecting that about 5% of the people aren't going to be around in order to exercise these things. Right? And then it says that during the 3rd year, they actually revise their estimate, right? From 10% to or 5% to 10%. Basically saying, hey, we're firing more people, or people are more transient, all right, these days, right? And so that's how we're accounting for things. So what we're going to do, in 2016, all right, at the end of 2016, we're going to record the compensation expense, right, at 95%, right, the 5%, instead of the full blown, 100% here. Okay. So if we apply a forfeiture, okay, we reduce, right, our estimate by 5%, or the total 95%, and that's how we came up with that. Okay. All right. We do the same thing in the 2nd year. However, when it comes to the 3rd year, okay, we have to reduce because we've already expensed, all right, 19,000 or 19 million or whatever it is, all right. I guess it is millions. And so what we're going to do is we're going to modify, right? And so we modify the forfeiture rate, right, from 95% down to 90%. Well, we've done 3/4 of that, okay? And so that's where we, so this was the total amount. Okay? The 80 million was the total amount. Okay? We're saying that, hey, we've already taken, 3/4 of that, or we're looking at the 3rd period, all right? And then we subtract what we've already amortized, and that's how we come up with the 16 million. And then we just, whatever's left, right? And so the 72, subtract the 54. The 54 is what we've already expensed up to this point. The 2 years at 19, right? So 38 plus the 54. I'm sorry, 38 plus the 16 gave us the 54. And we expense that portion in the last period. Just another ways to look at it or calculate it. All right, so we're changing our assumption. Okay, half the shares, 5 million shares, are exercised. All right, in July 11th, 2022, when the market price now is 55. All right, so again, all right, this allows us, all right, to purchase, all right, these shares for $35. Okay. And now they're selling for $50. And so we're going to make some money here, all right, or the employees are. Okay. And so the employees are going to have to, pay that $35 in, so that $35 is the same $35, so that goes to there. Okay. We reduce the paid in capital because this is after we've already, done the, the amortization of spreading it out. Half of 80 is 40. Okay, so the 80 times 0.5, half, right? Our common stock, right? Half of those shares, right? The 10 million shares, times 5% or 50% times $1 per share. That's how we come up with the 5. And then this is basically our plug. Okay. You know, we had the cash, we can calculate that. We have the paid in capital from the stock options, right? Half of the 80. This is always number of shares times par. And so our paid in capital is going to be the plug there. Then it says half the shares, 5 million shares. Yeah. Okay. Well, actually, you know, it says the remaining 5 million options are expire without being exercised. And so all we do is we, you know, reduce the paid in capital from the stock options, and we put it into, okay, paid in capital expiration of stock options. Plans with graded vesting, right? Cliff vesting, right? The stock option plans that vest become exercisable all at one single date. Okay. Whereas graded vesting, right, as it sounds, recipients gradually become eligible to exercise the options rather than all at once. Okay. And you know, if you ever do, if you ever look at the you know, the reports that are submitted to the SEC, okay, they actually have the total compensation for their executives. And I know that the guy from Disney, I think he just retired actually. You know, the CEO of Disney was always the highest paid executive for like years on end, right? His compensation, right, his actual salary really only consisted of, you know, a measly $300,000, all right, where most of his compensation came were in these types of stock options. And again, I believe most of his were graded, all right, where they gradually become exercisable. And so every year he would, you know, exercise the shares that he, you know, currently invested in or whatnot. So here's an example. A company might award stock options that vest 25% the first, 25 the second, and 50 in the third, right? A single fair value can be estimated for each of the options, even though they vest over different time periods, using a single weighted average expected life of the options. And so here's an example, all right? You know, we had 10 million, all right, executive stock options permitting executives to buy the 10 million shares stock for $25, you know, where the last scenario is 35. The vesting schedule is 20% the first year, 30 the second, and 50 the third. The value of the options vest over a 3-year period is estimated at January 1st, 2016 by looking at them this way. All right, and so the ones that vest in the first year, December 31st, 2016, was 20%. The fair value, all right, was this $3.50. All right, then there's the 30%. Okay, it's $4, 50%. And so all we're going to do is we're going to extend those. Okay, you know, so we just took the, you know, 2 million shares. Right, you know, add those all up. Get this, we're going to divide by 10, okay. And you know, we divide by 10, and what did I do there? Oh, I guess that's, oh, they're just showing the compensation expense recorded, all right? So after the first year, all right, we're going to expense, all right, I had to read this part up here, all right? You know, we're going to expense this full amount, right, in the first period, okay? Then in the second period, all right, we're going to, you know, expense, you know, this 12, all right, because they're going to get some from the first period, okay, and some from the second period, right? And so we're spreading those over the 2 periods, right? Okay, so we're basically taking this and dividing by 2 for the 2 years. This we're going to take and divide by 3, and you know, that's how we spread that expense, right, over the 3 periods. Stock option plans with performance or market conditions. Stock option plans specify a performance condition or a market condition that must be satisfied before the employees are allowed the benefits of the award. All right, and so it could be something to the effect, hey, you're not going to get these options unless we increase the market share of our organization, from 15% to 20%, right? Or, it's tied to something, some sort of performance condition. Right? The objective, right, to provide employees with additional incentive for managerial achievement. Okay, an option might not be exercisable until the performance target is met. Okay, the way such plans are accounted for depends on whether the condition is performance-based or market-based. And so, you know what? I think we're going to stop here for the day. We have 4 minutes left in class. And so I do want to give you guys an opportunity to ask any questions over the next 4 minutes, mostly about procedures. I'm going to stop our